In this episode, Jahed and I connect with Julia Lipton, the founder of Awesome People Ventures. Julia cut her teeth in venture capital on a first fund working on the future of work. Her exposure to crypto and blockchain inspired her to position her second fund at the center of the ownership economy. Julia's experience in web3 goes beyond her investment fund, and she is also the founder of a DAO and a platform that sources talent for web3 companies. In her work as both an investor and operator, she is constantly thinking about how to empower value-creating stakeholders in her ventures through unique earning mechanisms and governance rights. This episode will be relevant for both investors and operators trying to figure out how to align incentives in progressively decentralizing companies. We hope you enjoy the episode. Welcome, Julia. Thanks for joining us.
Thanks for having me.
So normally when we have guests on, we like to start out with their origin story or where they came from and how they got to where they are today. So can you walk us through your origin story?
Sure. So I started doing startups when I was still in college. So I would fly from LA to San Francisco every week. And I had joined a brand new company. I was the first business hire, and we launched the company during that time. And so at the time, it was, two founders, one engineer. There was another business hire who joined shortly after me, and I ran marketing for that company. And that company was a super high-flying, almost unicorn company. At one point, it was valued at $700 million and came crashing down to zero. And incredibly formative at understanding, what does product market fit not look like? What does good culture look like? What are ways to run a business, to not run a business? And in 3.5 years, probably could not have gotten a faster crash course in startups. And by the end of that, I got really sick and burned out, and I decided I only wanted to work on things that made people happier, healthier. And I joined a nutrition coaching company where I ran revenue for them. I promise this will get to investing in where we are now. But my lens, the reason why I share all this is my lens really comes from a 0 to 1 perspective, and with the growth, getting to product market fit lens. So I ran growth for the nutrition coaching company. We were bought after about a year by One Medical, and I launched and ran their telemedicine practice for a year. And after that, I took a sabbatical where I traveled around the world and met tons of digital nomads and people who are doing the future of work, what we now describe as the future of work, the way that most of Web3 works. The communities that I was surrounded by at the time in Southeast Asia, we're all working this way, picking up lots of different projects, contributing with people who they may or may not have known, likely never met in person, very almost bounty-based work, although consulting and freelance and gig economy style work. And I fell in love with the future of work, and I started consulting. And that made me really obsessed with talent. And the first thing I started before the fund was actually Awesome People Talent. And this was a BCC listserv where I would email out awesome people in my network that were talented and available for hire to my founder friends. And it was literally me just being like, I found this awesome person, you should hire them. And that was the beginning. And I did that because I was so in love with the consulting lifestyle and owning your cash flow and owning your day-to-day and having a lot more autonomy than in the traditional 9 to 5. And I was trying to prove to my friends that they could do it too. The challenge for my friends was that they didn't have enough demand, meaning they didn't have enough people that were willing to pay them. So I was trying to find them people to pay them, hence this newsletter. And while I was consulting, I became obsessed with angel investing. Before you know it, I was effectively running cash flow zero, working for one set of companies and investing in another set of companies. One of my friends saw me doing this and thought it was the stupidest thing he ever saw and encouraged me to start a fund. And very long story short, that is how Awesome People Ventures got started and has evolved over the last few years into what it is today.
Amazing. And the kind of attraction to Web3 was that, did you kind of get pulled into the blockchain, crypto, Web3 space from the interaction with digital nomads, or how was it the future of work as a team?
I first got interested in crypto in 2017. It was very bizarre during that time because the digital nomad scene was all about crypto. And you had people doing these really elaborate credit card schemes where you would, I never did this. This is insanely reckless, although not that dissimilar from what's happening across the market in mass today, but where people were borrowing lines of credit, buying Bitcoin or Ethereum, waiting for the price to go up, paying down their credit card with their earnings, increasing their lines of credit, and doing this on repeat. And this was happening in Thailand and Bali. There was buy local Bitcoin was how you'd get Bitcoin at the time, and all sorts of fanaticism in these places. And then when I came back to San Francisco, I had some friends who were convinced that Ethereum was the future of computing. And so I started getting interested in that. And I also had a lot of friends who were quite early, whether it was Polkadot or Solana. And so they were always telling me that I should get more involved in web3 or crypto. And I was just obsessed with healthcare and climate. So to me, this was nonsense. And to be honest, I really didn't care. I was like, okay, philosophically aligned, and we have some really, really big real world problems. And what happened is after I started the fund 1 was purely focused on Web2. We invested in those areas. After I finished fund 1, I could not look at another future of work, remote work company, B2B SaaS. To me, there was very little innovation and unseen inflection points in that space. And it wasn't exciting for me. And it didn't give me that same energy that I got in the early days of building in that 2011 era where I started. And so I took a break, and I also became very interested in, could you build a more decentralized venture fund? Because if you look at how wealth accrues in this country, or especially in tech, it's really unequal. And the distribution is, core GPs out large funds for the most part, founders and some angels, and everyone else is kind of a wash. And I felt this as an early employee in places where founders did well, but the early employees didn't. And so, and I feel it as an investor too, where you can refer a larger investor a deal. They make a ton of money off of it because their check size is bigger. And it's kind of irrelevant if you're writing like a 5K angel check. And so I became really, really interested in the decentralization of venture capital after fund 1, and just like, where's new exciting stuff? Where are people building things that truly feel like breakthroughs? And I took a break from fund 1, or from Awesome People Ventures after fund 1. And I just spent that year exploring my curiosities, which inevitably led me down the rabbit hole. And then before you know it, I just spent a year angel investing in Web3. And when I finally decided to raise another fund, the only intellectually honest thing to do was go all in.
Cool. So you've talked a little bit about kind of your perspective on crypto and the evolution, the future of work to kind of crypto or Web3. We talk about a lot of themes in this podcast around the ownership economy. Some of it's on blockchain, some of it's on traditional ownership structures, but overall we have, people come in with a different perspective on what the ownership economy means to them. It seems that the way that you're structuring Fund 2, the way that you're thinking about a new framework for venture capital suggests that you have a fairly specific way of viewing the ownership economy. So could you talk a little bit about what the ownership economy actually means to you and how you put it to practice in your work?
Yeah. The thing that I'm most interested in is value creation, attribution, and distribution. And to me, when you're creating value, some of that value should get attributed to you and therefore distributed back to you. And that by definition makes you a part owner, because the value ultimately gets attributed and distributed to the owners. And I think that applies across any business. So you could look at that from a perspective of venture capital, which I'll circle back to because I know that was your question, but you could think about that in relation to marketplace businesses. It's probably the other most obvious one. And those businesses, you have people doing work on either side. So in venture capital, it's sourcing deals, diligencing deals, supporting companies. In a marketplace business, it's whoever is buying and selling. And those are the people who are actually creating network value. In terms of Awesome People, what that means is we are pretty generous on carry sharing and trying to reward people who ultimately are helping us build the fund. And a lot of funds have scout programs. So we do reward for sourcing deals, but we're also building out a structure that enables us to reward for other functions as well. So right now we're hiring for someone to help us run our talent network. That person's going to have the choice of how they want to get compensated, whether it's a percentage share on revenue, whether it's a percentage ownership of that business, whether it's a percentage of carry of the fund. And these are all ways that hopefully we can give people ownership. It's really early days. And so exactly what the right incentive structure is and what things should ladder up to is very TBD. My intention is to work with people who understand that it's TBD and a grand experiment, because we're for certain going to mess stuff up. But the core premise is the same, which is if you're generating value for the network, you should be able to capture some of that network-wide value.
That's super cool. Honestly, I think some of the most forward thinking people in the space in the overlap between venture and Web3 are also thinking about this because they can step back and be a bit reflexive about it and say, well, actually, what does this imply for me and how I run this thing?
Yeah.
So on that front, you mentioned a lot of really interesting things. I'd be interested to hear a bit more about, if you're willing to go into it, like how you're thinking of structuring some of these things for awesome people, right? Because, there's a lot of hype around venture DAO this, venture DAO that. And I'm in a couple of these either for deal flow or just, trying to help people in my network source and fill out their rounds and what have you. But I'd be interested in hearing a bit more from you on specifics around, if you have spent, obviously you spent a year doing angel checks. Now you want to really go, full throttle into Web3 and VC. How are you thinking about structuring things specifically? Is it, are you going to be rewarding people for diligencing, sourcing? What's all in that value chain, right? When you talk about bringing value to it and then also recruiting some of that value back, what does it look like for you so far?
Yeah. So the way I thought it was going to work and the way it's going to work are totally different. I can tell you that already. So the way that I was thinking about it was to step back. We are not a traditional venture DAO, meaning we have traditional LPs on the back end. It's a 2 on 20 fund. The people who we're rewarding with carry and with ownership, that comes out of what otherwise would be my pocket. So I'm putting a percentage of my GP carry into that bucket that we can then give away. So it's not a traditional investment club in the sense traditional investment clubs, usually the dollars that go into the investment club come from all the participants in the club. In this case, the capital comes elsewhere. And then what we're figuring out is how to distribute that 2 on 20 fee carry structure. The way I thought it was going to work is that we'd reward everything from sourcing, diligencing, supporting companies, and supporting companies can include building all the programs we need to support companies. The easiest way for someone to imagine this would be, what if A16Z was built with the ownership economy? So they have a research arm, they have a platform team, they have all of these effectively analysts and principals. Most of them are just called partners. And what would it look like if people were rewarded solely based on their contribution? The challenges that I've run into so far is the system only makes sense if you're sharing upside with the community, if the community is enabling you to do less work, and in which case you're rewarding them for their work because ultimately it's work you no longer need to do. The challenge that we've run into with super early stage startups is most of the time when we're diligencing, even technical diligence, which is very surprising to me, I was not expecting this, people will totally disagree. And so then you still need to make the decision. So now what I've done is I have done all of this work to coordinate these people to be able to get all these inputs and then have to do more work to make a decision after that. At which case that tells me like the model just doesn't, like that particular workflow doesn't make sense because now you're giving up upside and you're doing more work. So That's a long way of saying like the way that I envision it is this equally distributed value chain, but it also has made me realize, and I hate to admit this, why VCs have traditional partnership structures where they like hire one person and they're like, we're just going to trust this person. And that is the way it is. And I think there are a lot more shots on goal and experiments that we can run. I think with like tighter diligence circles, with like more expert networks per deal type, we should be able to get better at this. But that's the North Star, right? It's how can you make the network more efficient than otherwise would be a traditional fund, and then share upside with them. And if you can't have a more efficient network, then the hypothesis is disproven.
That makes a lot of sense. And I think that's one of the really interesting things that you're hitting up against here is that I don't think you have to get in pretty deep into VC to really understand how it all works so that you can then come out on the other side of it and go, wow, there is such greenfield for experimentation here, right? Like for me, about a little over 3 years ago is when I sat down with a friend of mine and just went through like, what do we actually know about venture capital, right? What does the scientific literature know about it? What are the areas to innovate on? What are the results and facts that we know about it, right? And so from that, like this is, I think we were still in the middle of we hadn't even hit DeFi summer yet, right? So if we were just looking at this in November 2019, we were just thinking, hey, cool. It turns out that when you have founders and VCs who went to the same university, they're something like 33% more likely to make that investment, but those do 11% worse than their other investments. Interesting. If you could systematically structure an investment network where those interactions are not possible, or you control for them in some way, you might perform better than other VCs, right? That's just one thing, right? There's all kinds of opportunities like this where to, sort of correctly, the way you framed it is, I think, right, is how you structure a network around this so that it can be more efficient and also take advantage of some of these information asymmetries that a traditional fund can't because reasons, right? Either because of it's put together in a way where the incentives aren't aligned, or honestly, this might not sound so great. People might not even know these things, right? Like they're not sitting there going into the venture literature and going, I wonder how the last 30 years of venture went out, right? So I think that's super interesting. And then, so I guess, fully to admit this as well, I'm a part of an investment DAO in Cosmos as well, called Boring DAO. And I have very little say on that. I joined it late, so I didn't really play much of a role in how it was structured. But we were also thinking of things as, we'll set aside this part of fee for diligence, this much fee for sourcing, this much for, et cetera. And, so far, it seems, I don't know if you could say it's working or not, right? But what you really start to see, like you said, is that with the traditional fund, with the 2 and 20, and everyone just getting paid out of management fee, that turns out to actually be kind of an argument on the side of efficiency from what I've seen so far. Because when you start to sit there and add up, let me make a network of a long tail of people, and you run the economics, you're like, oh my God, we've already eaten up like 25% of the management fee or 80% of it, and we haven't even gotten to making the deal yet, right? So I'm really eager to see where you land on the end of this experiment, because from what I've seen so far, it's like it's all over the place. In some instances it works, in other instances it doesn't, and it's all about trying to figure out why. Why did it work? Right? Why did this one work?
Yeah, and I think the North Star for all DAOs is it only makes sense to be a DAO if that structure gives you more efficiency and better outcomes than the alternative.
That makes a ton of sense.
Well, actually, I should clarify. Sometimes DAOs are just fun, and it's like a cool, fun thing to do with your friends, and it's not outcomes oriented. And if it's not outcomes oriented, who cares? Do whatever you want. But in a world where you're expected to deliver outcomes against a market and perform, which for better or worse is the world of venture capital and any startup who takes venture capital dollars, then the North Star still has to be, how do we build a top performing structure?
I think that's a really good segue, because we're also really curious. Martin and I look at this from the outside and occasionally from the inside, depending on the DAO. But there's been a flurry of investment activity in DAOs, even leading into this month, right? With this new winter we're in, DAOs like Popcorn DAO, Super DAO, Vita DAO, My DAO, Prime, and more. And so really, I think what's interesting is, I'm just speaking from the perspective of Prime. It's been very interesting. I won't name any names yet because we're still kind of in the process of it, but it's been very interesting to see the names that have been popping up that are interested in the DAO space, right? So I'd be curious to know, from your perspective, what is this investment opportunity in DAOs from the perspective of a VC, right? Like you mentioned, some of them are just friends doing stuff on the internet together, and others are building.
I love those. Those are like the most fun places to hang out. I wouldn't necessarily invest in them, but
exactly. I am by positioning it that way, I am in no way saying they're good or bad. They just are, right? I'm in a number of them as well. They're fun, right? It's totally cool. But if you're sitting there as a VC and you're like, oh yeah, I got to go look at deep down, and there's like, there's now 13,000 of these things or whatever, right? Like, how do you think of it? How do you think of this investment opportunity in DAOs?
I think DAOs are just another structure. So it's not so much about like whether it's a DAO or not a DAO. It's what's this group trying to do? And do I think the structure is an efficient way to achieve it? And or what are the tokenomics? And what I mean by that is some of these things will inflate potentially beyond the value. The value that the crypto markets will perceive that they are creating is greater than the value of what the public markets would perceive that they're creating. In which case, from a venture perspective, the token may inflate enough that it looks like a venture scale investment when marked to the crypto markets, despite whatever their revenue may or may not be.
Got it. And then you mentioned a couple secular trends earlier in this when you were going through your background, stuff like the future of work and all that. So for you as an investor, do you also, like you said, the structure, it's just a structure, right? So you're not out there going like, I want to invest in DAOs. Is there really more of a sort of set of secular trends that you look at and say, I know these lead to strong product market fit. Oh, and it ends up being in a DAO, like that's whatever. I don't really care about the DAO part. Or is there some sort of calculation where you're kind of saying, oh, this one, there might be efficiency trade-offs. And I also believe in this strong overlap with, the future of maybe data ownership in healthcare or something like that, right? Is that kind of how you're,
yeah, I think there are definitely trends. There are definitely trends. And I do like DAOs for the reason that I think it's possible there are things that you can do in a DAO structure that you couldn't otherwise do as a corporation. So for example, I've invested in Archive DAO, which is building a real world art museum. That's something that wouldn't otherwise be possible. I can't just go and curate for the Smithsonian or like buy ownership in the Smithsonian. And so what I'm really interested in things that are net new. And the reason why I'm so interested in DAOs is I think there's a whole slew of things that are likely possible in a DAO structure that weren't possible before. I looked at tons of things that would now be considered under like decentralized cities. Before it was like shared ownership, real estate, or digital nomad, co-living, whatever name you want to give it. And when I look at the way Cabin runs, it's really interesting. I've also invested in Cabin. And those are things that the previous structures just couldn't do. And that's why I'm interested in DAOs, is it rolls up to that greater theme of what's net new. Like, what can we do today that we couldn't do before?
Can you just dive into those two examples and explain why a traditional organizational structure couldn't do what they're doing?
Yeah, I think the art one is the easiest. For starters, for better or worse, their access to capital in crypto and DAOs is much easier, right? So if we wanted to start a Kickstarter campaign or something like that and be like, hey, we want to raise $5 million to like go collect art, people will be like, I'm not sure about that. But now if you want to raise $5 million to go collect art and you own effectively fractions of that art and you have a say on what to do with it, that's a lot easier to raise money for. So I think there's an access to capital component, and is a more attractive asset from an investor standpoint because there is ownership. And that's part of it. The community part of it's real too. People want to participate. People want to curate. They want to be able to earn from curating. They want to be able to hang out around these projects and be involved and engaged in a way that you aren't with a company. You have no relationship with a company, so you can't motivate people to do work for you because there's no reason why you would do work for them unless you're one of their employees. I think those are kind of broadly at the DAO level. I think what's interesting about Archive is it ends up being both a really interesting social community cultural DAO, and it becomes fractionalized art, which if you believe in it as an asset is really attractive because it's a hard asset to get to unless you're a family office.
Okay, so one of this is just the democratization of the ownership. I guess I might push back a little bit on how much of the access to capital was driven by this 10-year liquidity boom, and whether or not that the kind of risk-off environment that we're moving into, whether or not that's going to continue as people are bleeding, and pretty much we've seen a 70% reduction in the market. But the fractionalization of ownership, I think, is real, and the ability to quickly build community and then deploy smaller amounts of capital, I think, is proven to be real. And it also sounds to me like, going back to the earlier conversation, that may be the real problem with venture capital and what, Andreessen is doing. It's not so much that you have these significant returns, right? Because effectively, what I heard you say earlier is that there really is a role for the principal at a venture capital firm, right? You've tried to kind of parse out this role and tried to make the actionable events that someone can take in sourcing or in diligence discrete. But the reality is that you actually need someone at the center of this to end up, owning the decision and the fiduciary responsibility and parsing out and learning from consistent investment opportunities over time to really understand a market. And so to create those discrete events is very hard with scale. And so if you kind of tease out how much of the inequality of the venture capital space is driven by the traditional 2 and 20 model with really large funds versus how much of it is generated by just a bunch of wealthy individuals that have access as LPs to have access to these. It sounds to me like there really is a role still for a key decision maker within a VC fund, and more of the inequality stems from super big funds with 2 and 20 models, or just the systematic nature of limited partners that have access to a lot of money, more so than the model itself being a problem. Would you agree with that? Or
yeah, I think there's truth to that. I think there's truth to that. And then your other comment about 70% of the capital leaving the market, I think that doesn't just impact DAOs and projects like this. I think that impacts any project, and it impacts even Web2 companies.
Yep, absolutely. I mean, valuations have come down dramatically. Multiples in the public markets have come down dramatically. And so, any entrepreneur that isn't cash rich today is going to face a fundamentally different negotiation when going back to the markets for the next round of capital. And a lot of people have kind of talked about that over the last few weeks.
I've been thinking about that a lot in the context of, in some ways, that makes venture more valuable than it is today because it's more of a necessity. Like, I remember when we raised our first round of funding in 2011. This is back when everyone had to build like their own databases, and you needed really strong backend teams, and you needed people who understood servers, even if they were cloud-based servers. So it was really expensive. And the only way to do that was to raise venture to hire these people full time. And as the cost of building has decreased, you need a lot less venture, which makes venture inherently less valuable or less important. And right now, it feels like there are a lot of projects that also need really heavy lifts where they can't just no code their way to their early milestones because they're building real technology again, where they need venture. And it feels a little bit reminiscent of 10 years ago, which does make the capital source more valuable than it was even 6 months ago.
I think there's something to that. I think there's also, though, as someone, and Jahed, I'd be interested to get your opinion because I feel like you're involved in every project in the world. You never have a free bid for a beer. But I think there's something to focus, right? And so one of the things that's happened for people that are talented in this space is that you have unlimited opportunity, right? And so you can just you can work 5 hours over here and 10 hours over here. And I just wonder how much we lose a little bit of kind of 10,000 hours, or, there was a good economist at University of Chicago when I was there, David Gallinson, who really looked at artists, and like where you have a lot of career success as an artist is either in your 20s or in your 60s, because you just don't have any time in between, right?
Yeah.
And so I just wonder how much, if we're going to all be doing multiple things, how much we can actually focus on doing one thing really well. And I look at this from my perspective. I mean, I don't, all three of us are involved in multiple things, right? You're running a venture fund. You're also running a human capital market, and you're also involved in DAOs, which I want to talk about as well. So one area that might also be value add for venture capital is that it's not just about, and I say this having never, deliberately never taken venture capital, but it's not just about having, a significant amount of runway. It's also having the ability to recruit in people that can really focus on something in a deliberate way for a long period of time. I remember when I was I lived in Bangladesh for a year and then lived in Dominican Republic for 3 years. And there was this super talented guy in Bangladesh that we ended up sponsoring his O visa. He came to the US. He now works as a senior engineer at WeWork and has children now. And there's no way that I could recruit him again, because the safety of WeWork, and the ability to kind of focus on a scalable solution with a lot of safety, there's just a different risk profile for people like that, even though he's one of the most talented people I know. So I think, this is a long-winded way of saying that, and I haven't thought about this before, that VC kind of allows you to focus as well.
Totally. And I was going to say, and that wasn't very clear in my previous statement, that's one of the reasons why I think that type of capital is more valuable now, is you do need to hire people that are insanely expensive, because the market has made these people insanely expensive.
Yeah.
Especially if you want the ones with experience, like your friend.
Yeah, absolutely.
And the older I get, the more I value experience, which I hate to admit, but is true.
So tell us a little bit about Fund 2. Where are you at in the process? How is it structured? What sort of deals are you looking for? What's the thesis?
It's all Web3. It's about 20 million. We've written we've invested in 10 companies, a couple of which we've already followed on to. And the thesis is generally around awesome people. Just find top 1% builders. And then there's obviously the areas where I'm more interested in. And a lot of those come to like user-owned projects, whether there's DAOs. We've invested in 3 DAOs, Cabin, Archive, and Solid World, which is Solid World in the carbon credit markets.
Nice. We're co-investors in that one then, just so we get all the disclosures out.
Disclosure. Yeah. And it's really awesome people that are enabling you to do net new things that weren't otherwise possible. So I've struggled with spaces and trying to figure out what my take is on things like, okay, now we can do payments, but it's crypto. Like, yeah, that's net new. And it's really important that we bridge and like fiat on-ramps and off-ramps. But like, what's something that like really wasn't possible before? And it's evolving. As the market changes, we change. That's the beauty of being a solo GP with a really flexible community, is we can adapt.
And was the decision to kind of, I mean, my understanding, and Jod, correct me if I'm wrong, there's a certain kind of limited number of LPs that you can have in any fund. Is it 99 or 499 or?
Depends on fund size.
99, yeah, it's 99 or 250, depending on how it's structured.
Okay. And so one thing that you mentioned earlier is that crypto leads to a lot more liquidity, the ability to raise market very quickly, the fractionalization of ownership, the ability to have smaller sums brought together. What drove the decision to have a traditional LP model and then crowd in kind of, or share, if you think about from a capital versus labor perspective, you've raised in a traditional LP model, and then you essentially try to democratize the labor within the fund. What drove that decision versus just trying to raise kind of a $20 million fund that was more of a investment club? Or community owned?
Yeah, it's a good question, because I think long-term, that's probably where we want to go. To be honest, largely it was because that's where Fund 1 started, and that's where my network is, and that's the path to raising large sums of capital, and to be able to figure out some of the mechanics that I wanted to figure out on a smaller scale. Like, I think if you start with a totally democratized fund to start, I'm in a bunch of these as an LP, and I haven't seen one that I think really nails it. I think it's a really, really hard problem to solve. Most of them still end up centralized. It's a handful of people doing all of the work, and they may not be the smartest people. They're just the people doing the work who have the time and capability. And so I'll take that. In most cases, they're the smartest people, but that's literally just a function of who has time, right? And so I wanted to create a sandbox where I could play and learn and change things. It's also really hard to change the rules within these investment DAOs once they start. And in my head, I was like, we might go through 10 iterations of this, which means we need like a really trusted, flexible group that's just down for the ride. But I agree with you in the spirit of intellectual honesty. Ideally, it goes more and more in that direction. The other thing I'll say about that direction that has always kind of bothered me is it means that you can only capture upside if, I think no matter what, you have to solve this labor equation, because if not, the rich are only getting richer. You only can capture the upside if you're an LP. And like that has always really bothered me. And so regardless, I'm really interested in the labor side.
Yeah, I mean, this is the problem of like capitalism, right? So if we had, I mean, when we talk about this all the time on here, you know, if we had a more efficient progressive tax system, A, or B, you had pension funds owned, or more people within the economy or within a economy having more access to financial assets that were then investing into VCs, either of those two things would solve kind of the macro problem of inequality driven by the fact that the LP base in most of these ventures are just really rich individuals or family offices. And so it seems like one of the things that I think is disconcerting is we have this macro trend towards kind of a decline of institutions in the United States. And so we can't really count on the tax issue anymore. And Jahed, you can jump on in here with your anarchism as soon as you want to. And the only other real way that inequality is solved is through war, right? So if you read kind of political economy, the only way to kind of get through this is either taxes, war, or figuring out these new structures, right? So I do think the LP equation is a super challenging question and also very interesting. I also think I'd be interested to get, before we get off this thread, and I thought about it earlier, I'd be interested to get your thoughts on like, what do you think the disconnect is at Andreessen at this point in terms of funding this space, but also having such a traditional structure? Or do you think that the way that they've kind of set this up is actually necessary in some regards, given the conversation that we've had today?
I think they're just playing a really different game. Like Andreessen is trying to build the next greatest financial institution. Like we look at them as a VC fund, but they're building like a JP Morgan or Goldman Sachs of how do you index the growth in the private markets, because that's where the growth is. It used to be in the public markets. And when you look at it that way, you're like, wow, it's pretty exceptional. If you think about like how many VPs there need to be at like a Goldman or any large financial institution, that's how many partners you're going to need.
Well, let's continue on that for a second before we get into the Web 2, Web 3 conversion. Do you think there's a misalignment of mission?
Yeah, I've talked to Mark and Chris about this. I have very mixed feelings, but what I will say to their credit is everyone there does have carry, which is not true of most funds. So it's better than most funds. And their mission is not our mission. Their mission is to generate the best returns and build a financial institution that can beat inflation. And I think we forget that.
Yeah. And I think also, if you focus too much on this.
I should say full disclosure too, that Mark and Chris are LPs in my fund. I got it.
Yeah, I'm aware. That's why I'm interested in kind of like, I'm trying, I totally appreciate your perspective on this. So I don't think that I see any sort of disconnect, but this is something that's talked about a lot in the space. And I think it goes to the heart of the question of how much can you decentralize finance when you're dealing with highly risky investments, right? Because and can you decentralize fiduciary responsibility in the way that we're talking about?
And they wouldn't say that's their mission.
Yeah.
Right.
Well, they would say, I would imagine that they would say that they want to democratize ownership and wealth. And it'd be interesting to do a quantitative analysis of their investments in firms where there is more democratization of ownership within the structures that they're funding. And I think that without them, this space certainly would not be where it is today. But it'd be interesting to do kind of a quantitative analysis to figure out whether their structure has, given their LP base, has a macroeconomic impact on inequality. I mean, I don't think anyone's going to be able to get that data anyways. So yeah, we'll have to hypothecate. But
I don't know. What I can say is, in terms of employment, they're now a decent sized employer and their employees do better than average. So if you want to think about that in the function of ownership.
Fair enough. So tell us a little bit.
I've definitely had conversations with Chris around like A16Z should become like the world's largest super DAO. So I hear some of the undertones in your comment and realize it is possible that they're building one of the world's greatest financial institutions of all time. And that's what they're building.
Yeah, fair enough. I just would hope if I was at their stage, I would quit. I would just be like, maybe I'll go, try something else for a while and, become an artist or.
These guys are very serious about being the best in the world at their craft. Like Chris still works his ass off.
Yeah, I believe it.
24/7.
Yeah, I believe it. So walk us through a little bit in these next kind of few minutes, the work that you do in the DAO space as an operator. And as I understand it, you're fairly active and both in DAO tooling. And I think it'd be interesting for our audience to understand, actually, and this is common for a lot of credible investors in the space. They're really operating in the space as well. And why did you make that decision? And what are some of the things that you're doing? You mentioned kind of the human capital network you're building, but you're also involved in a bunch of other areas as well, as I can tell.
Yeah. The most notable is I started a DAO called DAO Masters, which reviews DAO tools. And this is just because I'm obsessed with product reviews and I like DAO tools. And it's been really interesting because I started it and have since fully decentralized it. And it's interesting to watch the output of the DAO because I'm less involved today than I used to be. And if I'm honest, we've definitely slowed down. And it points to one of the reasons why I'm interested in this space, because when you're operating in it, you see the problems and you see what's necessary firsthand. And I'm a very I want to see and touch product. I want to see and touch problems. And for me, the only way to do that is to also build. And now when I see DAO tooling companies, I have a pretty strong perspective of what's a tool problem, what's a people problem, and what's a people coordination problem that can be solved by tools. And independent if I was an investor, last year I didn't have the fund and that's when I spent a lot of time getting into this stuff. It's kind of independent if I was an investor. I think it makes me a much better investor, but it's also just insanely interesting of how do you build these new structures to coordinate people.
Yeah, and I think it'd be interesting to kind of get your perspective on why things have slowed down, right? Because it seems that the literature on the anti-commons is kind of a good place to evaluate what happens with DAOs. There hasn't been a lot of quantitative analysis on this, but there was a really good paper that came out of China 3 or 4 months ago on Steam, and it looked at the performance of Steam over time, and you see a similar kind of phenomenon happen versus, say, Reddit in terms of the user metrics. Mm-hmm. And so in the tragedy of the anti-commons, you essentially have this coordination breakdown in which a single resource has numerous owners, each of which has the right to exclude others from it, but doesn't have enough privilege to really shape the outcomes. And we can go into, and it's a little more nuanced than that. And I don't want to bore our audience too much with economic papers, but it'd be interesting from a practical it'd be interesting from we'll put it in the show notes. So anyone that's got, too much time on their hands can read this stuff. But it'd be interesting from your perspective, what broke down and why are you not moving as fast? Because this goes to the tension of when do you decentralize?
It takes an insane amount of work to produce quality output. And how you incentivize people to do that work matters. And the give-get equation needs to be right. Like everything in life is a give-get equation, whether it's a product, a DAO, whatever. And what I mean by that is when people dive into DAOs, a lot of the reasons why they're working so hard is what they're getting is knowledge and experience and community. And that has diminishing returns. So if you want to keep people doing those functions, you need to keep finding new people to do that, or you need to come up with another way to incentivize them. And before you know it, you start to realize why you have full-time jobs and you pay people to do things.
Right. And so in the investments that in your kind of deal flow, how do you think about structure? How do you think about the cap table? How do you think about how much the initial team? Because have you come up with formulas? Have you come up with general kind of practices around this based on the deal flow that you're seeing and also your own experience in trying to...
From the founder's perspective, like how much they should own, what's their best...
Yeah, exactly. I mean, like just in terms of how much the founders and initial team should own, when a company should decentralize, how it should decentralize, how to keep that initial team kind of engaged through the decentralization process. It seems like you have a pretty unique perspective because you're seeing a bunch of deal flow and you've experienced this personally where you opted as a founder, and as I understand it, you had a fairly liquid token. So you're literally giving away a fairly kind of fungible asset to the community. It's not like this thing was trapped, and it was like kind of maybe some of it was, but effectively you've gone through the process of saying, okay, I want to give, a significant amount of value away to the community. Right. And so how have these learnings kind of impacted how you think about the types of ventures, structures and cap tables or tokenomics around the cap table? And are there any kind of best practices for entrepreneurs or for investors in this space?
I think in the beginning, you need people who are all in, at least a core small group, who are going to be willing to make hard decisions. Like I looked at a project the other day, which I love the premise of. I'm not going to share too many details because I don't want to out them given what I'm about to say. And the founder was trying to basically crowdsource what they should work on. And the problem they're trying to solve is insanely hard, requires BD with like traditional institutions, like enterprise deals. Like this is not the sort of thing that's naturally going to get done by like crowdsourcing what to work on and who wants to do what. And as much as I love the vision and the underlying tech, it's just not going to work. Like you need the best person in the world to go do those deals. You probably need to go find them and hire them, at least part-time. And I think there needs to be at least a core group of people initially driving the ship. And then over time, we'll see what are the best practices to progressive decentralization. You see that work for protocols. I don't think we've seen it work super well for product DAOs or other things in the ecosystem.
Have you seen it work well for marketplaces?
So Braintrust, it's kind of like a Web 2.5 company. I'm an investor in it, full disclosure. They had a very, very, very small team by the time they launched their token. And the reason why it works, they have a 10% take rate versus a traditional talent marketplace or agency model would have like a 40 to 60% take rate. The reason why it works is they get their companies and their talent referred by people in exchange for their token. What this means is they have a very low CAC of acquiring business and talent. And I think we'll see a lot more marketplaces who figure this out. And in this case, the unlock is you figured out how to use a token to change the underlying economics of the business such that you are a more efficient business than the traditional competitors. In theory, that should work for marketplaces. Now, I've looked at a lot of, the decentralized Ubers, the decentralized Lyfts. Like, some of these businesses are so operationally intensive and difficult and require top talent that I wouldn't necessarily, it's going to take a long time for us to figure out how to decentralize those types of marketplaces that are operationally complex.
Yeah, and Tomas Tungas at Redpoint has a really good article on Web2 versus Web3 CAC. Again, it would be interesting to see, over time, what happens with Braintrust in terms of their cost of acquisition. One of the things that I find so interesting about Braintrust is their decentralized kind of product team structure that tries to get around, the SEC rules, because they essentially want to say that this is a decentralized operation, but it's very clear that it's driven by, a pretty small core team. And so the way that they've set up product is you have essentially all these different squads that theoretically have their own roadmap and then come together to coordinate the roadmap. And I just wonder, how that works in practice. I mean, you actually have the same thing, Jahed, right? I mean, how much friction is there and how do you deal with conflict in such a structure?
Well, for us,
Prime, I'm thinking, right?
Yeah. For Prime, we basically, honestly, I view it as the full-throated version of what everyone spent the last 15 years trying to ape out of Spotify, right? Like, if you saw some of those old, they did presentations at Adult conferences, this, that, and the other. So everyone's like, great, we're going to do squads or pods or whatever it ends up being, right? But I feel like you can only do this. Julia's point around how much fucking work it is to actually ship good output is very true. And I think that those types of groups that, whether I never was inside of Spotify and knew one person who worked there and she could at least attest that this is how they were organized, those things at the end of the day only worked in very high trust environments with very skilled people, right? And so you can't just Dow your way to that, in my opinion. And I see this all the time in that the folks who are successful here have spent maybe 6 months failing at least to ship anything, and then discovering that, oh, wait, there's a whole, thing of, there's all kinds of frameworks for how to do this. We should try one, right? Or you're lucky and someone comes in and goes, actually, we should just use teal organizations, or we should use self-managing organizations, or what have you, right? There's some kind of way where that happens. So for us, we adopted a number of these things, but we didn't start from scratch. We were lucky in that many of us came out of Gitcoin or came out of some other organization that had adopted some kind of practice, and then we just copy pasted that and went to work with it, right? And so I think clarity, the Web3 notion, essentially, and means more than that now, but that's kind of what it was like when I first ran into it like a year ago. I also has a system that we've adopted internally, and I think the system is pretty much straightforward, right? We have folks who full-throated, legit, we mean it, are only leads. They don't have, authoritarian hierarchical power or other people to make them do things. And everything is basically voluntary. You have to do the thing. If you want to get paid, there's a whole bunch of ways that payment works. There are ways that work gets approved, which I'm happy to get into if you want to spend another 20 minutes on it. But basically, the point being that at the end of the day, there's a process for soliciting work. And honestly, it goes to the thing that Julia was saying, hey, let's try to do this thing for enterprise sales. It's never going to work, right? But if you're actually just going to ship a software feature, if you know a partner DAO that needs something and you know that they're going to pay for it, we trust that you actually have done the diligence work for that. It ends up in the backlog, it gets shipped, you're responsible for driving the adoption of it from end to end. There's a formalized relationship between a person that we sometimes call a requester and a person who's a customer for that work. The customer goes, hey, I want this thing. The requester or doer actually goes and gets it done. The customer is the one who says, hey, this actually meets the criteria or not. Honestly, if you've done any kind of agile work in a real way and not just through the rituals and nonsense that it's become, you should basically see some very common similarities with it, right? And so the idea being, how does it contrast to regular agile? Well, I'm somewhat cynical with this, having gone through a bunch of startups and my own, and that eventually agile collapses into, I guess you could call these people, it becomes dominated by rules followers who think that if you just follow the rules, good products will come out on the other end, which I don't think is true in my experience, not at all, right? And in the absence of those people, it just becomes dominated by power interests, and power interests are usually just dictated from the org chart on the wall back there, right? And so org chart says ship this thing, the company is structured to ship that thing, customer feedback may be interested in some way or not, and that's it, right? Whereas if you look at the way that we've kind of structured things, anyone can propose anything. Someone else has to be accountable for that thing getting done. That person isn't necessarily your boss. There's resources attached to it. A steward of that working group decides across all of those things how much to allocate in terms of functions. So that part is centralized, right? And it's as centralized as it can be at this point, where we have about 35, 40 contributors, right? And so, but at the end of the day, I can point to something like that and say, that idea isn't in there because I said so, right? Which, as a person who's led product at many companies, and my very cynical response at Product Tank one year, in my Product Tank talk, I kind of polled the audience. It's like, raise your hand. I walked them through a set of things. There's this new poll that came out through Alpha HQ or something, asking all product managers across the tech, from LinkedIn, Facebook, down to some random startup no one's heard of. When was the last time you talked to a customer? Right. And they had a number of really hilarious responses. And the other one being, when was the last time that you ran an experiment? Right. And the responses for both of these are roughly 80%. We haven't talked to one, or we haven't talked to them enough. And 80%, we don't run experiments, we don't run them enough. Right. So then it comes back around to like, how in these sexy companies leading, writing these blogs with how work works, how we work, right. And all that. How is it that in this audience of the top functioning, product people, this is what we actually are doing? And at the end of the day, to me, having the more really cynical response, but it's like, we like to write really nice narratives about how work works, but at the end of the day, it's dominated by power interests and hierarchy. And that's the problem, is that those are entangled, right? So like, they can be disentangled. And that's kind of my theory of DAOs, right? And that you can still have functional hierarchies that can assemble or disassemble as needed to ship a thing, but they don't entangle authority and power within them. And that kind of ends up being that's one of my theses for this stuff, right? For like, if it's actually going to be useful, efficient, and going to ship, maybe it works by disentangling power relations and actually letting people say, I want to opt in and build this thing. So that's my long-winded answer to how we do things at Prime.
That was great. I have a number of thoughts on that, but Julia, anything you want to add there?
No, I'll let you dive in.
Well, yeah, I mean, I think again, something we talk about a lot on this pod, but I think the challenge is going to be what you just described, Judd, is something that I think wouldn't pass the Howey test, right? So effectively, we got to get to this some sort of kind of law in the United States around governance and how these DAOs work, where you can have some sort of hierarchy, because effectively what you just described, is a security when you have any of that hierarchy in there, right? So it'll be interesting to see some of these. I'm particularly interested to see how the SEC treats Braintrust, because I think it's a really good example of something that, as you said, Julia, is Web 2.5, right? And it's not exactly clear how they've completely decentralized, but they also have a liquid token with a very high market cap. So that'll be interesting to see, because I think it's a very good example, and it's not something that should be regulated, but might be regulated as after the fact, because it's such a good example. The other thing that I was going to say is that we need, what I would like Ray Dalio to do, similar to I'd like kind of Mark Andreessen to quit and go fish. I'd like Ray Dalio to stop talking to us about macroeconomics, and maybe just open source his organizational designs, because he's done a lot of this work at Bridgewater. We've talked about that here as well, right? Like, when you're in a room at Bridgewater, you got people that are really good at credit, or really good at equity, or really good at swaps or whatever. And when those people are in the room, you can't talk about that issue because they're more credible, right? And I'm sure he's got a bunch of software at this point that does a lot of modeling of archetypes and modeling of skills around people. And this could be very relevant to kind of the work that you're doing, Julia, around DAO tooling. But if you could just open source some of those designs, I think it'd be very useful for anyone who's trying to build in this space, because you essentially have a way of demonstrating credibility or allocating credibility and reputation in a non-hierarchical way that allows teams to work together. So I think we'll see a lot more of that over the coming years, and organizational design, organizational psychology will come together with some of the kind of leaders in this space to create some of this tooling to help people. And this is kind of the work that Richard Bartlett's doing as well, right? I mean, at a kind of a smaller scale, but I think we'll see more and more of this.
Yeah, I like that idea.
Yeah, so I didn't think like coming around to the tail end of our time here. Martin, did I cut you off? Is there something else you want to follow up with there? Sorry. Well, two things then. One is this, I think, was a question that we like to ask more during the pandemic, or something that became one of my things I asked during the pandemic, because I got a lot of reading done during the pandemic, but during lockdown. But what are you reading these days? What books should be on our listeners' reading list?
Honestly, I've been spending just a ton of time talking to founders, and then been in a bit of like a medical health storm. So reading a bunch of personal medical stuff.
Oh, well, let me flip that question around to the first part of your sentence then, in that you're speaking with a lot of founders. What trends are you noticing in speaking with these founders? What's the most exciting stuff that's going to happen during winter, in your opinion?
Oh my gosh, I think there's so much. I think this is like the most exciting time. I think this is the time where we're going to start to see Web3 in the real world intersect. And I think that's so cool. Like I'm talking to a lot of healthcare-based projects right now, a lot of climate-based projects. Ironically, like a lot of the stuff that I was investing in Fund 1 that was Web 2 based, I think will actually get solved in Web 3, which is why I'm so excited about it. And I think in this era, we're going to start to see real world impact, which is super cool. So one example is there's quite a few projects right now trying to crowdsource healthcare data, which pharma already does for clinical trials and all sorts of reasons, but it's not quite true. It's not user owned first and user insights first. And once people start doing that and being able to contribute data to earn insights to be able to solve their own problems, and then ultimately be able to monetize that via pharma or some other way, and then capture more value, it gets really interesting. I think we're going to see a ton of projects like that. And hopefully then people will understand what the heck we're doing and talking about in this corner of the Web3 world once it starts to touch real lives.
Awesome. I think, and then lastly, since we did spend quite a bit of time getting into this, but one last shot, we want to make sure this is, a partly Web3 podcast. It is not a Web3 podcast, but it's partly Web3. And because of that, we have to give you a chance to shill. So please let the audience know where to find you online, follow your work, get involved.
The best thing to do is just follow me on Twitter, and it's at Julia Lipton. You can find all the good stuff there.
Awesome. Thank you, Julia, for spending time with us, especially given how busy you are these days. We really appreciate it.
Yeah, of course. Thank you guys for hosting.
My girl gave me a